Hey, what if you got $1 million today and you wanted to invest it? What should you do first? I mean, how should you go about this? Let's talk about it. Join me. Hello again. Welcome to the podcast, The Way I See It. My views on the economy, on finance, on personal finance, and how they all intersect. Thank you for the messages. Thank you for the questions you guys have been sending in. I do appreciate them, and it does help me. So keep sending them and keep telling your friends about the podcast. Let's grow something here, guys. This week, I want to talk about investing. And the most common question I get is, I want to invest. Someone says, hey, I have money, I want to invest. Then they ask me the question, they ask me, what should I buy? And that's always the wrong question. I explain to you why. If you wanted to buy a car and you went into a car showroom and you told the dealer, hey, I've got 10 million and I want to buy a car. What car should I buy? He's going to basically ask you, well, what are you going to do with the car? Are you going to use the car for agriculture, for business? Are you going to use the car for a wedding? Basically, the type of your purpose of buying the car tells the dealer what kind of car to then recommend to you. If you just want to go on a cruise to drive from, say, Lagos to Calabar, top down, that might give you a coupe. If you're going to carry yams and transport from your farm to market, maybe you want to get a pickup, that's sturdy and all that, 4x4 from your farm. So the purpose of why you want to buy a car determines the type of car that you then offer to you to purchase. It's the same with investing. If you want to invest, basically want to know, why are you investing? How old are you? What's your concept of risk? These questions allow us, if we were like a car salesman, to then determine what sort of assets we could offer to you to then meet those considerations, or to then meet what you want to achieve by investing. So the three things that I basically like to ask investors when they ask me, hey, what should I buy? I basically ask them, well, how old are you? Then I ask them, how much risk are you willing to take? Or if perhaps in a better way, what's your concept of risk? How do you define risk when you want to invest? Then I want to basically know how long they want to stay invested. So it's, how old are you? How do you define risk? I.e., what is your objective once you're investing? And then, of course, how long do you want to stay invested? These are very, very important questions to ask and to get a response back, because they determine the types of asset classes that we can then recommend as advisors to the client. So again, assets are all divided into separate classes, and assets that behave the same way can be grouped together. For instance, if you have a treasury bill and a bond and a fixed deposit or a debenture, they are all fixed income securities. They all have the same characteristics, i.e., they all advise you a coupon or an interest, which you know in advance. You know exactly what you're going to get. So they're called fixed income. You're aware of what's going to happen to your portfolio at the expiration of a certain tenure of that investment. Interest rates work on that. Inflation works on that, on the fixed income part of the bond, but you know what you're going to get because it's pre-told to you. So those are called asset classes. You have fixed income, you have variable income. Variable income will be things like equities, like when you buy shares, or things like commodities, when you say buy maize or crude oil. In this instance, you are not aware of what you're going to get at the end of the period. The prices could go up, the prices could come down. Basically, you could get a dividend, but you cannot say for certainty where the price of that equity that you're buying is going to be in a year's time or 2 years' time. If you compare that to fixed income, the instant you make the investment, you know how much your principal is, you know what the coupon is, and you can determine how much you're going to yield back to yourself at the end of that tenure. So we have, in terms of asset classes, just two broad classifications: fixed income and, of course, variable income. So let's go right back to the very top. If you had $1 million to invest, how would you invest it? If you came to me, I would say, well, the first question is, how old are you? Why do I want to know how old are you? Because the age determines how long you can invest and also gives me an idea of the kinds of risk that you can be willing to take. I give you an example. If you are 60, maybe you've retired or you're about to retire and you want to invest, I would be very careful about offering you equities as the main asset class in your portfolio. Why? Because equities are very, very risky. You could lose 100%, you could gain 100%. So because of that, it's going to be a problem if you're going to retire and you're going to earn a pension, which is going to be like a fixed pay salary paid out to you. You have no margin of error. If you lose your investments, you have nothing else coming in. You can't just go easily get a job because you're already at a later stage of your work life. So the age you are determines the sort of investment that is recommended to you. If you're much, much older, you should have a much, much lower proportion of variable income in your portfolio. If you're younger, yes, you have a longer period of compounding ahead of you. So yes, you should invest in equities. Yes, you can take more risk because you have more time to recover should those bets you have taken turn otherwise ugly. So the age is the first key question we want to find out. How old are you? Because that tells us what sort of investments are key for you at that age. Very important. The second is going to be, like I said, how much risk you want to take, but in the question of what are your objectives. So we want to ask you, hey, why are you investing? Okay, we know you're 45 years old, but what's the objective of you putting this money aside? Well, they are just going to be, if you take a spectrum, on the left-hand side of the spectrum, you're going to have capital preservation, in which case your main objective here is to preserve your capital. You want return, don't get me wrong. You want the money to grow, but your overriding objective for investing is to preserve the capital. Well, on the other side is the opposite. Here you have capital appreciation, in which case your main objective is to appreciate your capital, i.e., to make it grow. Now, these two are the two ends of the spectrum. When you want to preserve capital, that says to me that your risk profile is very, very low. You are looking at saving the principal, maybe earning an income on that principal, but you don't want to basically put that principal at risk of dissipation. So your attitude to risk is very, very conservative. That's basically what that answer tells us. What about capital appreciation? If you say you want to appreciate your capital, what that tells me that you want to employ that capital to take risk, to ride the volatility train and see where it takes you to. Well, in a planned, measured manner. So that means you want to take more risk. You want to grow that principle, which is why you want to basically risk that principle to appreciate it. So you're either preserving the capital or you are appreciating the capital. If you're preserving the capital, then your risk profile is set to be lower than a gentleman that wants to appreciate his capital. So of course, the first thing we've said is the age. If we know your age, we can know your how long or what kind of investments we can offer to you. And we give the example of the pensioner at 16 shouldn't be doing a lot of equities. The second objective or second question I want to find from you then is, what are your objectives or what is your attitude to risk? And we've said, if you say, hey, I want to preserve my capital, the signal I get back is that, listen, your risk tolerance is kind of low or lower than the person that wants to do a capital appreciation. So that then tells me, okay, is that a kind of investment I could offer to you? To be like, I'll give an example, same thing. If I have a younger client that wants to appreciate his capital, what is telling me is that the bulk of his capital should be overweight in equities, because equities are risky, but they do offer the rewards of the volatility and the appreciation of that capital. They could go from 0 to 100, or it can go from 100 to 0. But that volatility in that up and down movement, the price does go up, or the price can come down. So he's willing to risk some capital, to risk that capital to enjoy that higher growth. That's basically what it tells me. Then the last question, like I said, I want to find out from him is, why or how long do you want to stay invested? This is not to do with the age now, but how long are you investing? So if a guy comes and says, I'm 30 years old, I want to appreciate my capital, but I need the money back by next quarter, so 3 months. That automatically means you should not maybe do equities, because equities need a longer time to mature, to grow, to get ingrained. You might just want to go and do treasury bills, not because treasury bills fit the risk profile, but the client is already telling you he needs his money back in 3 months. So that's an overriding need. Maybe he needs to pay rent, or needs to send his daughter to university. You can't then tell him, oh, hold on, the investment we've taken will mature next month. He needs the funds in 3 months. So that also tells you the kind of investment that you should then deploy the client's funds into. And you can see that these three elements all have to match up. You cannot have an objective to say, for instance, I want to preserve my capital, which means I have a low risk tolerance, but I want my money back in 3 months, and I want to make a lot of money. I want my principal to grow and double. That's going to be what we call a mismatched goal, because your risk profile is low, but you're trying to make a double on your principal. So the goals are not matching. If you want to double the principal, you have to put the principal to risk. If you want to preserve the principal, then you're basically preserving that capital and keeping it away from the risky market. And remember what we said, there are two main types of asset classes. Either it's fixed income or it's variable income. So let's tie all this back together. Just like we give you the example of when you walk into a car studio and you say, I want to buy a car. The good salesman will ask you, well, what are you doing with the car? Or what do you want to do? What's the purpose of you buying the car? And the answer you give him lets him know the kind of car to offer. It's the same with investments. So when you go to your advisor and you have $1 million and you want to invest, you should already have in your mind, this is my age. My age tells the investor how long I have, how many compounding periods are ahead of me. It allows him to say, okay, I can do this sort of investment, I can do this sort of investment. You also want to have your attitude to risk all agreed. Do you want to preserve capital? Do you want to appreciate capital? You should be able to understand what they mean and what it means in terms of return. Can you risk your principal to get a higher return in future? Or do you want to preserve that principal and just get the income that accrues to you from that principal? And of course, the last one you want to make sure he's very clear about is how long you want to stay invested. If you have a 10-year horizon, then you've opened up a universe of asset classes he can recommend to you. Then if you say have a 1-year investment window, in which case, even though you might have profitable options, he cannot offer you any options beyond those 12 months that make up the year, right? So those three things are very sacrosanct. You must know them before you can then communicate them, which means that the lesson for us is that we have to go back and ask ourselves, okay, what is my objective? And you can have many funds with different objectives. You could take the $1 million and split into two and say, this fund is for my retirement. So I'm looking at capital preservation on this portion. But this other portion is my money that I want to basically invest in the market and see what it gets me. So I have a 50-50 portfolio, and this 50% is going to be capital preservation, and this other 50% is going to be capital appreciation and all that. You can do that, but you have to have your objective. You have to know how long you want to stay invested. And of course, your age that you can change per se determines how long or you can be in the market. And very importantly, what sort of securities can be offered to you. I go back to the point again of the retiree. If you are retired and you no longer have the means or the ability to get a new job and you want a fixed income, you want to be very, very careful about making investments in variable return asset classes, because if anything goes wrong, that fixed income that you would enjoy, you won't have that anymore. So that shuts out a lot of risky investments from you. That's just advisory. don't take risk when you are basically at the stage that you do not have time to recover from those risks. So that's the summary of it. Know your age, know your objective, know how long you want to invest. And that then enables the advisor to do what's called an asset allocation for you, which means you take those assets you've given to him and he'll create a table of fixed income, of variable income, and give them percentages of and create a plan for you. Asset allocation is the key reason if you will make profit, if you make a loss, and if you would meet your investing objectives. Once you can get your asset allocation correct, you are already on your way to success. But you can't get the allocation correct if you don't tell your advisor how old you are, what you want to do with the money, i.e. objectives, and your attitude to risk, and how long you're going to stay investing. So thanks, guys, for listening. I appreciate you guys. Once again, like I said, tell your friends. Meet me here next week. We'll have another topic for you. Thank you. I appreciate you guys. Thank you.